Good afternoon, my fellow traders. My name is Michalis. I'd like to welcome everybody to the first webinar of this week. And today's webinar is slightly different to webinars that we've looked at in the past, where we're looking at developing a trading strategy and also developing a trading plan. So it's kind of something in between, because we've done a lot of webinars where we're looking at people that have already been trading. So somebody that has been trading maybe 6 months, maybe 3 months, maybe 9 months. And we've done a lot of webinars where we're looking at, these individuals, how can they improve their webinars? Today, improve their trading strategy, improve their trend, improve their trading plan, and so on and so forth. Today, we're looking at something in between. We're looking at the first steps into developing trading strategy. Of course, there's always two sides to a strategy. There's the strategy itself, identifying requirements, being able to develop a bias, being able to, by yourselves, develop a signal. And there's also the side of developing a trading plan as well. So this is what we're going to be looking at today. It's a very unique webinar because it's the first steps is, as you start as a beginner, somebody which is not an experienced trader, those first steps into developing a trading strategy. Now, of course, today's webinar isn't a live analysis webinar. We're not on the MT5. We're not looking at the live market. It is a presentation. But of course, guys, I don't want everybody to think that because it's a presentation, you have your notepad, you got your pen, you write your notes, and that is it. Of course, you can ask as many questions as you like. Feel free to share with us some of your stories, some of your experiences. If there's something that you're finding difficult while trading, please share it with us. Please ask questions. I will read it out automatically. Of course, I won't expose any sensitive information such as your name and so on and so forth. But of course, I'll read it out and we can discuss it together as a group. So this is a great thing about webinars. Yes, it's educational, but it's a great way of communicating with more experienced traders, with other traders, with beginners, hearing other people's stories, and so on and so forth. Today, though, we're going to look at how to develop those very first steps in the financial trading market. This is what we're going to look at today. Before I go into that in more detail, though, we've got only 2 slides as an introduction. Very quickly, I'll go through these slides very, very quickly. So the first thing I want to say as part of this webinar, this slide here, is yes, of course, there's a lot of educational material here, but it's not there to be deemed as investment advice. You, of course, have full control over your investment. We will never give you advice or tell you whether you should be buying or selling and when and so on and so forth. What we are doing is we put a presentation together. It's for educational purposes only. Moving on to the next slide. Very quickly, I want to tell people just a little bit about my background, because a lot of people, a lot of the time, they ask me and they send me messages on LinkedIn, they send me emails and so on and so forth, saying, how can we trust you? And I think if you learn a little bit about my background, you will know exactly if or if not, I know what I'm talking about. So my name is Michalis. I've been in the financial service market since 2014. Originally, I was a financial advisor for 4 years. That was in London. I've been a market analyst now for almost 6 years. I am registered on the FCA's website as a certified CMAP individual. Also, I'm certified on CISEC website as well. So on 2 regulators. So I'm a fully approved certified individual. Now, let's start off looking at trading strategies. How to start to get into the mindset of looking at a trading strategy, how to develop a trading strategy. And of course, there's always 2 sides of the trading strategy. A lot of people, that when they start trading, have never traded before. We've got a lot of beginners, and this is why we do so much educational events and seminars and webinars, trading courses and videos. This is the reason why we do so. And of course, if anybody ever has any questions, of course, always feel free to send us an email. But a lot of people, they come into the financial trading markets, they're looking at the MT5, they're looking at their platform, they're just scanning through the different markets, they see something that they relatively know well. For example, it could be a stock, it could be the NASDAQ, could be a currency. They try to see what kind of type of price movement is taking place, they try to follow it, and that's it. And you know, yeah, there's always two sides of things which people need to look at it. When you're starting off, and it's your first thoughts within the financial trading market, those very first steps, there's always one side, 50%, which is your trading strategy that we need to develop. And then of course, you've got your trading plan that we need to develop. And one is as important as the other. Of course, you need to take into consideration that you cannot have a trading plan without a trading strategy, and you cannot have a trading strategy without having a trading plan. It's like a married couple. They come in hand, always. So of course, that's something that we're going to look at as part of today's webinar. Before we start to look at today's webinar, to start to look at this slide, I'm just going to very quickly release a poll, okay? So what kind of trader are you? There's a reason why I'm asking this. I'm asking what kind of trader you are, because of course, throughout today's webinar, I want to have a good idea on what different examples I can give people. Because of course, yes, it's a presentation, but of course, if necessary, and if people want certain examples, I will go onto the MT5 and we'll look at in-depth examples. So I'm not going to leave this poll up for long. I will only leave it up for 45 seconds. I can see 50% of people have already voted. Let's try and get it to 60% at least. We can get 2 more people voting. 2 more people, 1 more person. There we go. So I'll share the results actually. So we have 42% of individuals have advised that they're day traders. So they're opening and closing the trade within the single day. 16% said they're swing traders. Swing traders is if you're keeping trades open more than 24 hours, but not necessarily in the long term. 11% have said they're long-term traders, which is actually quite rare because CFDs tend to be known to be appropriate and advantageous for medium to short-term traders. But of course, everybody has the ability to consider long-term investments as well. And then very popular as well, we've got 32% are scalpers. So ultra short-term trading. So I'll keep that in mind when we're looking at different examples today. So the first thing that people need to think about is developing a trading strategy, developing a trading plan, which come in hand. So that is of course important for you to notice. It comes in hand. You cannot start trading because like I said, a lot of people, they start in the market, they start trading, they don't have a trading plan. They don't have a trading strategy. The first thing people will start to do is they'll start to look at the charts and start to open trades, but they don't have a set strategy. They may be on the first day opening certain trades based on certain elements. Later in the day, it will be on other elements. The next day, it will be a completely different view. And the next thing that they realize is that, okay, we need a strategy. We need to identify a strategy. They do a strategy, and normally their success rate will increase, but not increase enough. Somebody trading without a strategy, without experience, may have a success rate of 30 to 40%. Once they build that strategy, it can, and most of the time it increases because they're now trading with a strategy and they're also trading with some experience now. So it can increase, for example, from 50 to 60. They realize it's not good enough to have a success rate of 50, 55, 60%. The next thing that they do is they look at building a trading plan, which again ideally is going to increase the success rates. Instead of doing that, what we're looking at as part of today's webinar is taking the appropriate first steps into the financial trading market. Because I can guarantee you, for example, somebody who has studied as a financial advisor, like I have, or an economist, it could be, for example, CIRA, it could be CMAP, DIFA, all these different licenses, and then they go into investment banks. They don't sit them in front of the computer and say, okay, trade. They develop a trading strategy, they develop a trading plan. To be honest, large institutions, they have set plans, algorithms, strategies, and it's just about fitting into one of those categories. They don't let you develop your own one. Because of course they've been developing it after many, many years of experience. So as beginners, people say to me a lot of the time, why do beginners have a lower success rate than these large institutions? And this is one of the reasons. Those large institutions, they're trading with a strategy, a very well-known strategy, something they've been doing for many years. Trading plan, the same thing applies. So instead of coming into the market, making mistakes, start off on the right foot. Now, if you've already traded, you've already had some bad trades and so on and so forth, it's not too late. This is going to be a great webinar for you. But if these are your first steps, there's also a very big advantage to this as well. So of course keep that in mind. So your first thoughts, okay, very simple to understand. The first thing you need to take into consideration is which assets are you going to trade. One of the biggest mistakes that beginners do is they're scanning through the different assets on their screen and they're trading all of the assets. Or one day they're trading one asset, the next day they're trading a different asset, the next day they're trading a different asset. And what I will say to you, and by the way, I can see some questions, I will answer these questions in a moment. What I will say to you is every single asset is different. It doesn't take somebody who has studied being an economist or financial advisor, it doesn't take somebody with a lot of years experience to say that the Euro USD is the same as the NASDAQ, or the NASDAQ is the same as gold, or that gold is the same as a stock. It is not the same. And it doesn't take somebody who's very clever to know that. So every time you change assets, you're starting again from the beginning. So let's say you've been trading 1 month, you've taken the right decision and you've only traded one asset that month. You've gained 1 month's experience for that asset. You know the traditional price characteristics of the asset, the traditional value, its price range, how it reacts to certain indications, the domino effect of that asset. So what different elements and movements within the market influence that asset, and the list goes on and on and on because you've gained experience and knowledge for that asset. If after 1 month you've gone from trading the NASDAQ to trading oil, none of that which you have learned applies. So you're starting again as a beginner. So don't make that first mistake of trading any asset. You don't want to trade any asset. You want to trade a specific asset, your chosen specific asset, and don't keep changing assets or trade a million different assets at the same time. Because your knowledge and your experience when trading that one asset will be much vaster and faster, should we say faster growth, should we say, in terms of your knowledge, if you're trading one asset. So which asset are you going to trade? That's your first thought as a beginner. You've logged in, it's the first time you're logging in, first thing that you need to think about. The second thing, during which sessions and hours are you going to trade? There's 3 trading sessions. Of course, actually there's, should we say, many different trading sessions, but there's 3 well-known trading sessions. Of course, you've got the London session, you have the Asian session, you have the US session. Of course, each asset reacts differently in each session. For example, if you're looking at a UK stock, okay, for example, it could be Tesco stocks. of course, it's going to have most volatility when the UK, the London session is open, because that's where the market is trading the stock. Of course, during the Asian session, that market is closed. It's not going to have much volatility. So the price characteristics are going to change. Or for example, if you're in the UK session, and a lot of people have been buying, they're buying, and now you're an hour and a half away from the UK session ending and the US session starting, or should we say the US session really gaining momentum, but the UK session ending. You're 90 minutes away from that session ending. You know, of course, it's a lot of the time, a lot of people that were buying, they start to cash in. We released a poll a few minutes ago and asked people what kind of traders they are. They said they were day traders. Day traders, ladies and gentlemen, they close their trades at the end of the day. So you can see here, it's important to know what session you're going to trade, what hours you're going to trade. A lot of traders, professional traders, which have a lot of years experience, they will trade one asset, maybe two assets, and they will trade it in a certain window. So it could be, for example, from 2 o'clock to 5 o'clock UK time, for example. So keep that in mind, because also a lot of people, they don't want to be sitting in front of their screens for hours and hours and hours. Nobody's going to be willing to do that. Yes, for those individuals that don't want to trade at all, yes, we have copy trading, we have PAM accounts, we have different options, in which case people are trading for you for 24 hours a day potentially. But if you're trading yourself, then of course you want to set yourself a certain window. And the good thing is, in terms of this, again, assets react differently during different sessions. So you're limiting yourself to knowing how the asset normally reacts during that session. So again, you're really concentrating on something specific. So when you learn it, you're successful at it. Because if you're, again, trying to trade everything at any time, anywhere, and so on and so forth, then of course it becomes more difficult. Your trade size. If you're looking at your first thoughts within the market, so you're just starting out as a beginner, a lot of people, they say, you know, I want to earn X amount. Don't think about the money just yet, okay? Of course, everybody's here for profit. You know, we're not saying that's not the case. Everybody's here for profit. Everybody wants to earn every single month as high as profit as possible. So we're not denying that. But we definitely want our traders to trade responsibly and safely as well. So the main thing as a beginner is to improve your success rate. So become a better trader. When you become a more experienced, better trader, then really start to concentrate on how much money can I make, okay? So first, look at your trade size. Look at, for example, you may aim for opening the very minimum trade size, which is 0.01. Don't look at the profit, look at your success rate, okay? Because as a beginner, like I said, you may have a low success rate, maybe 30%, maybe 40, maybe 50%. As you gain experience and as that increases, when it gets to something that you're comfortable with, so for example, 80%, then it's at that point that you say, yes, of course, there's certain risks, and we're going to look to monitor those risks and limit those risks and so on. But how much money can I make? I've now got an 80% success rate. It's a great success rate. You know, how much money can I make? So everything needs to be done step by step in the appropriate order. Not saying to yourself, I want to earn 300% this month, and then at the end of the month saying, oh wait, I've only got a 30% success rate. That's looking at it the wrong way. We're going to look at this in more detail though. Your trading methodology. Are you a short-term trader? Do you want to be a short-term trader? Do you want to be a long-term trader? You could be a scalper, which is ultra short-term. You can be day trader, which is short-term. There's swing trading, which is classified as short to medium term, because of course some swing traders have trades open for 7 days and 8 days. Some swing traders only have them open for 40 hours or so. So that's something for you to take into consideration. Now, depending on this, okay, will depend on which account you are going to trade. Make sure you are picking the appropriate account, all right? So certain accounts, ladies and gentlemen, have, for example, zero spread, which of course still means that there is a spread, but it's a raw spread. So basically, this is the spread that the market offers. We as HFM are not adding anything to it. So per trade that you open, we actually don't get anything in terms of the spread because it's what is known as a raw spread. Okay, you can write that down and also Google it and search it yourself. But what we do is we have commissions. So here, for example, we have commissions. So especially scalpers, all right, because scalpers, what they don't want to see is that the spread keeps changing. So 1 minute there's a spread of 1 pip, the next minute there's a spread of 1.5 pips, then a minute later it's 2 pips, and then it's back down to half a pip. That's not what scalpers want to see. They want it to be fixed. So a lot of scalpers, they prefer to say, I want zero spreads, but I prefer a fixed commission. So I know that every single time this is the commission. So that may be something which is appropriate for you. Depends on you, like I said. Some people may prefer a pro account, in which case it's not zero spreads, but it's extremely low spreads, and there's no commission, especially on Forex pairs. Or some people may want to see very low deposits, for example, an account with no minimum deposit requirement, in which case you can look at the spread. And then, of course, we've got the premium, which is a more, should we say, simple account. It has nothing major there. There's never any commissions on it. It has just standard spreads. It has no minimum deposit. So it's a very typical account. So really think about your requirements and whether you want to be trading on the zero, the pro, and premium account. That needs to be as well in your first thoughts. Because of course you want to be trading on the right account. Keep a trade journal, definitely. That's something which is very beneficial to beginner traders. We've actually got a page about trade journals, so we're going to look at that in a minute. Know your entries, know your exits. We're going to look at this in only 2 slides, so not the next slide, the slide after this. That's something very important. This is about number 7. It's about your trading strategy. Okay, you need to know how to develop a bias for the day or the bias for the hour. So for example, somebody's going to say, I'm an ultra short-term trader. I keep trades open for only a couple of minutes. I'm only going to be trading an hour. How do I develop the bias for the hour? So a bearish bias, a bullish bias. So this is one side of the strategy. The other side of the strategy is what requirements are there that I'm going to set in place for me to open buy positions and for me to open sell positions. So it's like saying there's a checklist. I have, a checklist here. So 1, 2, 3. So it's like a checklist. These 3 are my requirements. So if 1, 2, 3 happen, then I've met my requirements to open a buy position. I've met my requirements to open a sell position. And the other thing is how many trades per week. Number 8 is what is your goal? Now, the goal needs to be responsible. A lot of people say to me, because we do a lot of polls where I say to individuals, tell me what you struggle with. Okay, so that way I know how to help you, especially when we do live webinars. I say to people, I'm here, I'm on the MT5. What do you need help with? And normally I would have thought to myself, people will say to me, I want help with strategies. I want help with understanding X, Y, Z. Actually, most of the time people say, I want to learn how to control my emotions, because I get emotional, I get scared. I hate it when I close a losing trade. And after closing a losing trade, I feel like I'm trying to get back on track. And because of that emotion, I open my trades wrong. I open wrong trades. And most of the time, emotional trading is because, okay, yes, because you don't have a trading plan. So that's partially one of the reasons. But the other reason, ladies and gentlemen, is actually this reason here, number 8, because your goal is wrong. To put things very politely, should we say. You know, a lot of beginner traders, they're, you know, depositing $25, they're depositing $50, and they want every single month to earn $100 every single month. They want to withdraw $100 every month. So they put $50 every month. I want to withdraw $100. Sounds great. Yes, of course. But that's a 200% return. A 200% return every single month. That's almost 2,500% return by the end of the year. So, you know, when you look at professional traders, when you look at large institutions, when you look at Goldman Sachs, JP Morgan, when you look at, for example, I worked at Platinum in London, they're never anywhere near these types of returns. They're not trying to do so. Why? Because they will fail at it. And why? Because you start to get into bad habits and emotional trading. So set the right goals. Goal number 1, we've already mentioned it. Forget about the money just yet. Make sure your success rate is appropriate. When I say forget about the money, I don't mean, you know, lose your money or anything like that. Yes, of course, you don't want to lose any money. But the main thing is look at your success rate. Is your success rate 50%? Great, that's quite good for a beginner, somebody that's never traded, then this is their first week. Try to get it to 60. That's your first aim. Try to get it to 70. When you're at 70, most probably you're seeing some kind of profit, maybe you're at a break even. If not, there's something seriously wrong with your reward to risk ratio, which we're also going to look at. Something very, very important. I try and look at that in every single webinar, or at least twice a month. So, you know, you've improved to 70%. You know, you're at a decent area now, a decent range. You can start to look at money. You can start to look at profit, what you're going to aim for. But something, for example, which is responsible is, for example, 5%. Now, there's no fixed right and wrong. It's not what I'm saying. But this is a good example. Your first thought. So let's go through this very quickly. I've answered everything for you now, so you've got a good idea of a trading plan. So, for example, Euro USD is the asset I'm going to trade. Why am I going to trade that asset? Because number 1, on a pro account, it has no commissions, it has the lowest spread, and it has no overnight fees. Okay, so number 1, I'm at an advantage. So this is the first thing. So keep that in mind. You don't have to choose this. You may choose the NASDAQ, you may choose gold. It's completely down to you. But the Euro USD, why not take advantage of these things? No spread, no swap, no commissions, the lowest spread on the platform. Sounds great, right? All right. So that's number 1. Number 2, I'm going to be trading UK hours between 12 o'clock and 3 o'clock. You can lower that, for example, saying I'm only going to be trading for 2 hours. It's completely down to you. I'm a beginner, so I'm going to open the very, very, very minimum trade size, 0.01. I'm not going to get cocky and say to myself, some trades I'm going to open 5 times higher because I'm 100% certain. There is no such thing as 100% certain in the financial trading market. If you go on to YouTube and type in Bloomberg and listen to economists and listen to, for example, the director of Goldman Sachs and very large players within the market, they always say to you that they're not certain and they're prepared. A very big thing about the markets is it's not about being right. It's about being prepared no matter what happens to the price. Whether the price is declining or increasing, you should be prepared and being able to alter in a way that you're still profitable, if that makes sense. Methodology day trader. I'm using the pro account because I want super low spreads, but to be trading without a swap fee. There's no swap fee on the pro account looking at the Euro USD. Trade journal. I will make a note of my trades at the end of every single day and review them at the end of every single week. We're going to look at a trade journal in more detail. So know your entries and exits. We're going to look at a strategy in 2 slides time. So we will look at an actual strategy, guys. We'll develop a strategy now. But my reward to risk ratio, I'm going to look to earn $40 per trade, $40 per trade, and risk $30 per trade. That's just an example, okay? It doesn't have to be that reward to risk ratio. So actually, I'm only trading with a 0.01%, a 0.01 lot. So actually, that's not necessarily correct now that I really look at it. It's more of a reward to risk ratio of looking to earn $4 and risk $3 per trade. How many trades per week? 7 trades per week. What is my goal? Goal, of course, number 1, to increase my success rate. Also, number 2, to ensure that I'm is to earn 5% by the end of the year. So PMC is per calendar month. So let's look at the questions before I continue looking through the webinar. How much commission per trade? It's available on the website. I don't have all the figures here, to be honest with you, but it's all available on the website because it depends on the asset that you're trading. Of course, if you're trading in NASDAQ, it's a different fee to trading a European index. Trading, for example, the Euro USD is very different to trading an exotic currency pair. So depending on the asset, the commission is different. It's available on the website. If you need help or need somebody to tell you the commission because you cannot find it, very simply go to our chat on our website, the live chat. Somebody will answer you straight away, instantly, guys. Of course, we closed over the weekend. Alternatively, you can give us a call as well. So keep that in mind. And of course, we'll provide the information for you. Can you go over keeping the trade journal? Yes, I will. There's a slide where we're going to look through the trade journal. So I don't want to look at it twice. I've mentioned it, but we're going to cover it on a different slide. Somebody says to me, hello, the presenter, can you please raise your hand? I'm guessing the individual is trying to figure out if it's a real webinar or fake webinar. Yes, I can raise my hand. Yeah, it's absolutely fine. So that's me raising my hand, guys. I've got some more questions. This is quite a big one. So 2 more questions and I'll go through the slide and then we'll continue with the questions. So somebody here says that he's got a strategy. The strategy works very well. He's only doing it on a demo account. He doesn't have the confidence though to go onto a live account. So he's written quite a big paragraph. Thank you for that, by the way, guys, to this gentleman. So he says he's got a good success rate. He's confident, it's working, it's profitable, it's on the demo account. Doesn't have the confidence yet to go onto the live account. What I will say, okay, so it's about emotional trading again. We've already mentioned emotional trading in this webinar. What I will say is, because demo trading is very different to live trading. You may find something is successful on the demo account, but on the real account, it's not successful. Not because there's a difference between the two. There's no difference between the two whatsoever, but because of emotions. So what I will say is, open a small trading account. He's mentioned here, for example, 3,000. Open a much smaller account. Start off with something very small, so small that your emotions are not going to get the best of you because you absolutely don't care about that money because it's a small amount. open the very smallest trade size and test the strategy on a live account, okay? If you're still seeing the same results, okay, and it's successful and you're profitable every single week, don't go crazy. Take it from a 0.01 lot to 0.02 lots. And to be honest, these emotions, they go away as you start to trade and as you gain experience and gain confidence. But as long as you're on the demo account and thinking about quite a lot of money, because 3,000 can be quite a lot of money, you will never go into a live account. So think about that, I will say. That's something which is very, very helpful. But if you've got something more questions in regards to that or something specific, feel free to email us. And of course, we can look at it in a lot more detail. The same guy says he wants to treat trading as a full-time job. So he wants to learn as much as possible. That's absolutely fine. That's down to you, of course. What I will say is make sure you're profitable first before doing that. What I will say, because of course there is many profitable traders, professional traders. We've got people that are strategy providers as well. That's something you can take into consideration. If, as you say, you are profitable and you're successful, of course, that's something you can take into consideration. People, guys, can also, if they've got a great strategy, like this gentleman is saying, he can share his strategy to other traders who can copy him. And every time they earn a profit, he can say, at the end of the week, if I've made you X amount of money, this is my fee. And it's a split of however much profit has been made. So if at the end of the week they've made, for example, $1,000, he may say my fee is 10% of that, so it's $100. So that's something for you to take into consideration. Last question, and we'll look at the slide because people keep adding more questions. What is the best time of day to trade? There's no correct answer to that. It depends on your method. Also depends on the asset that you're trading. So that's a very quick answer. So developing your trading strategy. The first thing that we're going to look at is the time of trade. If you're going to take into consideration, because I'm going through this because on the next slide, we're going to look at the actual strategy itself. Are you going to allow multiple trades or are you going to be open one trade at a time? So not multiple assets, one asset, Euro USD, for example, but are we going to be, as there's volatility to add a trade, another trade, another trade, another trade, and then exit at a different point. So there's multiple trades open, which is known as the scaling methodology, or you're going to be opening a single trade. So it could be one single trade for one session with a take profit or stop loss, or it could be stepping, the stepping methodology, in which case you're opening trade, closing it, opening the next trade, closing it multiple times within the strategy. We're going to look at what the example we're going to look at as part of today, but that's something we need to take into consideration. What indicators are we going to use? That's something we shouldn't be testing indicators, guys. If you've got a developing trading strategy, we're testing them, finding out which ones we want to use, confirming that, and then putting it as part of our trading strategy. We shouldn't be having a trading strategy and none of these have been tested. Are we going to trade the trend or we're going to trade the price movement against the trend? For example, it could be a retracement, it could be a correction, it could be a pullback. Time frames, we should know what time frames to be using. Ideally to use multiple time frames. Most people that aim to have 3 time frames, an ultra short term time frame, this is for day trading, by the way, ultra short term time frame, a short term time frame, and then a short to medium term time frame. So for example, the 5 minutes, the half an hour, and 2 hour, for example. The trade requirements, we're going to look at the trade requirements on the next slide. So it's like that checklist of this is what is required per trade to be open. And also how to develop the trading bias. What do I mean by trading bias? Is by looking at the market and saying, okay, because XYZ has happened, I'm going to have this bias for today. So ideally, I want to be looking at buy trades. So yes, there's going to be volatility. There's going to be times where the price is going to decline, but I'm going to concentrate on buy trades because that's the bias which I have of the day. Of course, the bias can change, but nonetheless, you have a bias. So for example, if we're looking at the NASDAQ, somebody may say, to build that bias, I'm going to look at all US indices, not just one on our platforms, but generally speaking, it could be also the Russell 2000, in which case, you can get access to that on Google. So you're building a bias saying that if the Dow Jones, the S&P 500, and the Russell 2000 is increasing in value, my bias is going to be that the NASDAQ is also going to increase today. In addition to this, I'll look at global indices. I'll look at the DAX, the CAC, the Nikkei 225. I'll look at the Euro Stoxx 50. If all of those are also increasing in value, I have a buy bias. You may say to yourself, I also want US bond yields to be declining, and I also want the VIX to be declining, which is a risk indicator. So you can see I'm building a bias. I'm building requirements, not on the chart, but based on what is happening within the market today. So again, that is also something for us to take into consideration. Building a bias. Today, because we've looked at quite a lot of webinars in August about building a bias, let's look at a strategy, okay? So here, ladies and gentlemen, we have, by the way, I can see some more questions. Someone says, what's the minimum deposit? Minimum deposit, we don't have a minimum deposit on certain trades, on certain accounts, for example, like the cent account. So yes, that's the answer to that question. So starting your trading strategy, this is the Euro USD, ladies and gentlemen. This is also, by the way, a 5-minute time frame. So I've got a 100 bar EMA. So it's a 100 period EMA. How does it appear on the charts? It appears like this, ladies and gentlemen. So it's very simply just a line. Very, very simple. Just a line. And it's an average price of the previous 100 candlesticks. But let's not go into that into too much detail. Then I've got an RSI here. The RSI is on an 18 period. You can see 3 lines. We have a line here, ladies and gentlemen, which is at 75. The middle is at 50. And the third line down below is at 25. Okay? And it's also on the period of 18. There we go. So how are we trading here? This is a momentum-based strategy. So I want to be trading below the trend line and only trading sells. When above the trend line, I only want to be trading buys. Now, it doesn't mean where the price is below is only going to be declining, or where the price is above it's only going to be increasing in value. It's not that simple. But there's a bias towards that direction, and there's a signal towards that direction. So this is an example here. It's a downward trend. Because it's a downward trend, of course, we're going to be below this trend line. Now, in addition to this, I also want to be trading in the areas where we're between 25 and 50. So on the lower side of the RSI. But I don't want to be oversold. So for example, here I'm oversold. Also, for example, here I'm oversold. And I don't want to be trading where we're between 50 and 75. So you can see by doing that, I'm avoiding this area of the market here where the market's moving against me. This area of the market here again where the market is moving against me also. Let's erase that so everybody can see a clearer screen. So what am I basically doing? As long as we're below the 50, above 25, that's requirement number 1. Requirement number 2, we're below the 100 period EMA on the 5-minute time frame. Now, the other requirement, okay, is that I'm also going to look at the US dollar index and make sure that is increasing in value. And I'm also going to look at the euro index and make sure that is increasing in value. Sorry, decreasing in value. So an increase in US dollar, a decrease in euro, not against each other, but against the whole market itself. So there's no conflict there. So that's my third requirement. But how we're going to enter, if we've ticked those boxes, ladies and gentlemen, how we're going to enter our trades. So this is what we're going to do today. This is, by the way, guys, a recent example. This isn't a very old example. So here we can see, ladies and gentlemen, the price opened the session here. Okay, this is where the price opened the session, started to retrace here. Now, this is the low, ladies and gentlemen. This is why I've got a red line here. So the price did something like this, and this is the low. As it starts to decline, like so, as soon as it crosses below this line, that's why I'm opening my sell trade. The other thing I want to check is that down here, and as you can see, that is the case, we are between the 25 and 50. So that's the first trade. I've opened a trade here, okay? So that's my first trade. Then you can see the price retraced again. It moved all the way up here. So we've got another low here. So basically we've had, you know, a low here. The price has done this. We've already entered one trade. The price does this. I've got another low here. Again, you can see here, let's change the color actually, so people can see it more easier. So you can see here, we have another downward crossover. So it's at that point, open a second trade. Then we can see a retracement again. The price retraces all the way up to here. This is the next crossover. The price declines, and this is where I cross over. Okay, so that's another scenario. It retraces again here. That's where it retraces again. Now this is the low. It crossed below here. Okay, on that occasion, for the first time, it only slightly crossed below, but nonetheless, you know, we don't know that it's about to come back up. So we would have opened that trade nonetheless. The trade moved against us, but then moved back in our favor. This is the low, and then we opened another trade here. And we can see the price is all the way down here. This is the next low. Then it crossed over here. So we opened another trade there as well. So how many trades did we open in total? We opened the trade here, so one trade, two trades, three trades, four trades, five trades, and six trades. The price at the moment is here, okay? So we've opened 6 trades. Out of those 6 trades, 5 of those trades are currently in a profit. Of course, after that, we don't know what happened. We can only see so much on the chart so far. We have to keep looking at it and see how the market would have developed. So that's a profit, that's a profit, that's a profit, that's a profit, that's a profit. That's currently in a loss at the moment, not here our stop loss just yet. So you can see how I've built a bias. I'm trading a decline in euro, increase in US dollar against the whole market, not just against each other. The price is below the 100 period EMA, and the price is also below the 25 and 50 on the RSI. So very clear indication that sellers are controlling the market. I've opened 6 trades already so far, 5 are in a profit. Okay, to be honest, if the 6th one closes in a loss, I don't really care, because I've got 5 trades in a profit, 1 was in a loss. So happy days. If that's the scenario every single time, it means I've got an 80% success rate, 80% success rate, which is very good. So let's move on. The next thing, which I'm also going to be doing while doing that, ladies and gentlemen, is 2 things. Sorry, not the next thing. Simultaneously, I'm going to be doing 2 things. I'm going to have a 75 period exponential moving average, which is this green line, but on a 2-hour chart. Okay, on a 2-hour chart. I also want those buy signals and sell signals on the 5-minute chart using the strategy here, okay, on this previous slide. I also want that to go hand in hand with what we're seeing here. So we were looking at sell trades. I want those sell trades to have been here, okay, because we're below our 75-bar exponential moving average. So we're getting the same signal on the 2-hour and the same signal on the 5 minutes as well. No conflict, no conflicting signals. Now the next thing, the same time, I'm doing this, ladies and gentlemen. Now this is on the different assets, but it's just an example. You would do the same on the Euro USD. Each time we get a retracement, so it retraces here. We had a retracement here. We had a retracement here. There's a retracement here as well. Each time there's a retracement, okay, there's actually 5 retracements here, because if we look closely, it retraced here, there was a retracement here, a retraced here, a retraced, and there's a retracement here. I'm measuring every single retracement. So you can see here 1.28, 0.82, 0.78, 0.88, 0.5%. Now, of course, this is extraordinary, a retracement of more than almost 1.30%. So if we ignore that, what do you notice? All of the retracements are more or less the same. So it's about building the traditional characteristic of the price movement and understanding how normally the price is moving, price action, known as price action plan. So there's different things people do. People, of course, are going to take all of them into consideration. But a lot of the time they'll look at these and say, you know, of the past week or of the past day, it's up to you, you know, what is the average size of the retracement, okay? So when the price moves against the trend, so it's a downward price movement like this, you know that large retracements, they've gone up to here, small retracements have gone up to here. On average, they normally go up to there on average. So, you know, as it hits here, start to take into consideration, you know, is the trend going to continue? Because normally this is where it would take place, okay? Doesn't mean it's going to take place there. Maybe it's going to be a complete change in trend, because you know, if it's going to decline below here, yes, there's been a lot of downward movement, so maybe now we're going to get a retracement upwards. But if it's gone that far, more than we traditionally normally see, actually, is there going to be a change in trend? Because we're now outside of characteristic. So again, you're getting a good understanding of the price movement of the asset. Now, this isn't simple, it's quite advanced, because you're doing quite a lot of things, like I said, but it's very effective in getting a good understanding of the price movement and determining how the price is going to move. So let's continue. I've got some more questions. What is the name of the indicator you are using under the candlestick? Are you referring, I've got some questions here, one moment. Are you referring to the RSI or are you referring to the red lines? So if I go back, if you look here, ladies and gentlemen, here you can see there's an RSI. Is that what you're referring to under the candlesticks? It's known as an RSI, Relative Strength Index. Now, if you're referring to these red lines, it's not an indicator. I'm personally drawing those. So each time I go to a low like this, I personally go onto the chart and I draw a red line there because it helps me. I know that, you know, if it starts to decline like this is where I'm going to open my sell. Or if it's the opposite direction, this is where I'm going to open my buy. Can you teach the strategy privately? Yes, if you speak to your account manager, you can arrange one-on-one sessions. Of course. So I think that's all the questions. I've got a lot of comments here saying great webinar and things like this. Thanks for the feedback, guys. It's much appreciated. But I think I've answered all the questions. So let's carry on. Now, this is a different strategy because I wanted to give you a second option. Now, when you're doing this, you're still looking at these two charts. You're still on the 2 hour, looking at the 75 exponential moving average. For example, here, you can see the 75 exponential moving average is on the 2 hour chart. So you're still doing that, and you're still looking at the waves as well, but you're not basing it on the crossovers like we were previously. So I've got 3 moving average. We've got the yellow, which as you can see here is a 25 simple moving average. The blue is a 53 moving average. Sorry, 23, 53, and 73 here. Now, if you're in a trend, and the great thing about this, I'll explain in a moment. To get signals, you need them to be widening. You don't want them to be crossing over each other. So for example, here, you can see they're crossing over each other. You don't want that. Here again, they're crossing over each other. You don't want that. You want them to clearly be separated and widened. So for example, here, all the way up to here, you can see they're separated and widened. So that's where you're going to be looking to trade. Now, if the price is going to decline below the yellow but above the blue, it's considered as potentially about to give you a strong signal. If it's between the blue and as low as the orange, it's a weak signal. If it goes below the orange, we have no signal. So how do you get a signal? As it drops below, okay, so for example, here, it drops below. Okay, you can see just about it drops below. Here it drops below. You count back 4 candlesticks. So we've got 1, 2, 3, 4. Okay, so you count back 4 candlesticks. So all the way here, ladies and gentlemen. Now, based on the high, that's where you're going to open your buy. Okay, now that high may not be the swing high. It may not be the swing high. It's just the high of those 4 candlesticks. So that's where you would have bought a buy. So you would have bought a buy just below. So you would have bought a buy here. Then the price started to decline. You would have bought a buy here. Then the price started to decline again, drop below here. So we count back 4 candlesticks again. 1, 2, 3, 4. Then the next high is at this red line, crossed over here. So that's where you open the buy again. Okay, so you've opened so far a trade. You've opened so far a trade here, then you've opened the trade here. Then again, the price declines below 4 candlesticks, the high is here. Ladies and gentlemen, so you would have bought a buy also here. Drops below again here, so that's the high. Drops again below here, so that's the high as well. So you also had the buy here, you also had the buy here. Of course, that last signal would have been considered a weaker signal. So you can see here, you've got other ways to enter. This is a different strategy, slightly more advanced, maybe not so appropriate for ultra beginners, but this is also a strategy. And the great thing about the strategy is, you know, this area here where the moving averages are crossed over, here again where the moving averages are crossed over, it's showing you that this area is very difficult. There's a lot of up and down volatility, so we're not trading there. So it's showing you where the easier areas of the market is. You can merge the two strategies, in which case you've got these lines and you only trade, you know, in these areas, like I said, between here and here, where the lines are separated, clear direction, they're widened, but you concentrate on breaking highs. So for example, the breaking high here, the breaking high here, the breaking high here, and so on and so forth. That's an option as well. So that's another strategy for you to look at. The only thing I will say is here we've got, for example, here we're looking at, I can't remember what asset we're looking at here, but the 23, 53, and 75 worked very well, gave us very good signals. Here is gold on the 5-minute time frame, and you can actually see that it doesn't work well here. It doesn't give you any signals at all. You have a lovely price movement here, lovely price movement, but you can't see any signals. It never goes above the yellow, never goes above the blue either. So we're not even getting weaker signals. So what does that mean? It means we have to amend the numbers here on the moving averages, not look at 23, 53, 73, amend it and lower them so we're able to get a signal. But I cannot give you a fixed number because it's different for every single asset. But to be honest, it's something you can find out by yourself very easily. You put those that we mentioned on. Is it giving you signals? No. Slightly amend it. Test another number, a lower number. So for example, instead of it being 23, 53, 73, look at 13, 43, 63, for example, and so on and so forth. Trade journal. Somebody asked about a trade journal earlier on. I'll change the color of the pen because now we're on a different color. So we're going to start to look at trade journals now, ladies and gentlemen. Trade journals is a great thing, especially for beginners. Every single day, at the end of when you finish trading, look at your trades and say, how many trades did I open? Did I open 5 trades? Were 3 of them profitable and I closed 2 in a loss? I'm going to write that down. Tomorrow when I trade, I'll write it down again. The next day, every single day, I'll make a note of what I'm doing. I'll note of how I opened the trades, how I closed them, how did I decide that, what I traded, when I traded it. Because what you want to see is how you could improve your trading plan. That's the next step. You've got your strategy, you've got your trading plan. How are you going to improve your trading plan? So for example, if you today I opened, like I said, 5, 3 were in a profit, 2 in a loss, that's a 60% success rate. I'm making a note of that. If every single day I'm seeing 60%, 60%, 60%, it's been 2 months, every single day I see 60%, then I know I'm not improving. If it decreases, I know I'm doing something wrong. So this is why it's very important to look at a trade journal, okay? What's also very important is to look at analyzing your trades. Look at your trade today, okay? If you open 5 trades, let's look at them. Look at where your take profit was, where your stop loss was, for example. So let's say, for example, let's say I opened the trade here, and I also opened the trade here, for example. Here you can see the price went all the way up to here. The price went all the way up to here. I was very close before retracement. Here, I'm very, very close before the end of the trend, okay? So I can't really amend it. I'm putting my take profit very, very close towards the end. What I actually would do is those trades which were in a loss, did I open a trade here, put my take profit here, and did the price do something like this? Is that why I lost those trades? Because if that's the case, because you can see here, I'm very, very close to the end, very close to the end. I'm playing with my luck here. If that's the case, maybe placing this lower take profit, putting my take profit here, would have actually taken my success rate from 60% to 80%, for example, which is a great thing, of course. So take that into consideration. You can see I'm using my trade journal to improve my trading. Let's look at a different scenario here. Here, ladies and gentlemen, is the opposite. I can see I'm profitable. I opened here, I closed here, I opened here, I closed here. I could have tried to earn 5 pips more, for example. Here again, I could have tried to earn 5 pips more. If on every single occasion that I was right, I could have earned more, maybe I want to consider increasing my take profit, okay? That's also something that we can take into consideration. For example, it's all about looking at your reward to risk ratio and your success rate. We're very, very close to the end of the webinar, guys, but this is a very important thing now that I'm going to look at. This is the last slide. Look at these statistics. Here we got Jude, Mr. Jude, like the actor Jude Law, for example. He's opening every single week, 30 trades. His reward to risk ratio is 1 to 5. 1 to 5 is the reward to risk ratio. So he's looking to earn 10 and he's risking 50. He's risking 5 times more than he's looking to earn. This is known as a negative reward to risk ratio. So it means he's putting his take profit very close and he's giving his trade a lot of time and a lot of space for volatility. Maybe he's scared of volatility. A lot of the time, the price hits his stop loss and then moves back and would have hit his take profit. So he's decided to continue with a negative reward to risk ratio. Not necessarily something bad, as long as you have a very high success rate. So for example, here his success rate is 90%. So per trade that he's opening, 30 trades that is a week, he's actually got 27 in a profit, 3 in a loss. So even though he's got a very negative reward to risk ratio, at 27 times 10 is 230, 50 times 3 is 150. So he's still in a profit of $120 per week. But he needs to look at this and see, you know, yes, I'm giving my trade a lot of time on purpose, but can I increase my take profit? You know, can I maybe put it to $15, for example? If you know, maybe 60% of the time he could have, 40% it would have mean he would have hit his stop loss, then of course that's not something he wants to do. He's profitable at the moment, but he's using his trade journal and his statistics to improve his trading. Different scenario here. This is somebody, Timmy Tope, a completely different scenario. 30 trades per week. Reward to risk ratio 4 to 1, so very high. Looking to earn 32, is risking per trade $8. He's only got a success rate of 35%, so he's probably a new trader, not great at determining the price movement. His profit is 152 because 11 times 32 is 136. 19 times 8 is 152. So he's earning 153, actually, I believe. Anyway, he's in a profit. So that is something, ladies and gentlemen, again, he's going to look at. He's got a very low success rate, but he's still profitable because he's got a high reward to risk ratio. So he knows he's got a low success rate, but he's amending his reward to risk ratio to still ensure, regardless of the fact he's got a low success rate, to still ensure that he's a profitable trader based on those statistics. But as he becomes more experienced and he becomes a better trader, hopefully that will increase. So for example, if that increases to 40%, can he change his reward to risk ratio to be less strict, to give him some more time if the market moves against him instead of $8 only? If he looks at his stop loss, if he gave himself more time, will that also improve his success rate from 40 to 45 and so on and so forth? So he's playing about with the statistics of his trading. So that's the end of today's webinar. We've been speaking now for an hour and 10 minutes, so we've been speaking too long actually, but hopefully you found it educational and found it informative. If you've got questions, feel free to ask. I will leave 2 minutes on the screen if people want to ask some questions. Otherwise, of course, we'll end today's session. If anybody has questions, feel free to ask. Otherwise, you're more than welcome to leave today's session. Okay, I can't see any questions. So I think let's end it for today. So a lot of thank you etc. It's my pleasure, guys. If you, of course, at any time need assistance or there's something specific you want to email us about, of course, feel free to email us at any point. Okay, so I can't see any questions. Let's end today's session. Enjoy the rest of your evening, guys, and we'll speak very soon. In the meantime, goodbye.